Moderator Kaushik to the desk, and the other panelists Mr. Chinamaya, Anjan and Girish. And I call upon the members to come to the front seats so that there is a more concentration. No distraction and only concentration. Yes. So I request the Kaushik to take on the charge for this panel discussion. Thank you.
So very happy evening again, once again to everybody. So today's discussion, I would like to start upon with one of the interesting aspects in terms of the technological developments that are happening. The world is now moving towards automation, and a lot of AI talks that are happening in terms of prompt-based technology that is evolving in the industry for all aspects in terms of all the activities. So I would like to understand from the panelists today how an AI-based or an AI-inspired valuation activity impact the valuation profession as a whole, and is that the reliance, how reliant can be the AI-inspired valuation reports. So I would like to take views from each of the panelists one after the other. First, I would like to take views from Chinmaya.
Sure, Kaushik, thank you. Maybe I'll restrict my answer to PPA so that every complexion is covered by others as well. One of the points, in fact, I was also making in the presentation about when we were talking about data. So data at the earliest level would itself be an asset. Once we know the composition and complexion of data, that is again a different asset. And then in the similar example of the B2C kind of data where an acquirer, once the data is acquired and the machine is learned that data, an acquirer's algorithm or the acquirer's machines are learned, the data is learned, then the value of that algorithm or machine will improve because that has learned the data. And that's how a migration of a value chain, the data's value chain will be there. On an overall basis, I think it will be too early for anybody, any valuer also to know how exactly data will impact. But it is for sure at least that, even if you take a 6 months break, you will be too much behind the way you look at the transaction, the way you look at the industry in such a rapid growth environment.
Your thoughts, Girish?
Hello. So, valuation as a field has traditionally had some facets which are different from other financial services. Right? One is extensive use of comparative data, market available data, public data. That's always been there. Second, models that valuers use, backshows, other option pricing models, or other complicated statistical / mathematical models have always been there. So, use of technology in valuation, I think has always been there at various degrees. Either you write a macro in Excel or write a formula in Excel or whatever it is, automation or use of technology is being more in valuation as a field than others. Especially when requirement to comply is becoming higher and higher in terms of the valuation standards that you covered, or the requirement to comply with various laws for a single purpose. I think models, computer models can help a lot in making sure that all of those are ticked. Whether AI models can do an entire valuation, people have tried. There are a lot of products that are available in the market that claim to do that. But I think you can still not remove human in the loop from valuation as well. There will still be a discretion element and a judgment element. That is as important today, and I think it will be important tomorrow as well. The degree and the percentage of involvement may reduce, but I think humans will still. So I think both of them are very much part of the game. Like he said, there are so many changes that are continuously happening, tools are available, you've got better models to analyze, you can Ashwat Damodaran puts up, I don't know, some terabytes worth of data, analyzing every company in the world that is listed. So more and more you'll have those the computer assist available. You should still use your discretion and bring it both together.
Anjan, your thoughts?
Yeah, so let me break it down into two parts, right? As I see it, AI is coming into places where rudimentary tasks are involved. And as Girish also told, valuation involves a lot of judgment. So, it's interesting how we look at valuation today. We sort of burrowed ourselves into a hole thinking valuation is emanating from statutes. But I am of the firm belief that valuation as a discipline, as an art or a science or whatever it is called, it comes from the fact that you need to take investment decisions. That is, you need to park your money if you think something is undervalued, or if you have to take a position on an exit way if you think something is overvalued. And I don't think AI can come into valuation until it goes down into these, first the players like portfolio management services, mutual funds. In such places, let AI come and take over. Let AI start taking decisions there. So, why do we feel like we need a human there? We still feel like we need a human there. So, that's because it requires a human judgment. So, I think up until the time AI cannot take over mutual fund houses, portfolio management services or analyst roles, I don't think it can enter into this sector that we are in today. This is the first part. The second part is, I totally agree with Girish that when it comes to the administrative part of the valuation, we can really automate it. I wouldn't call it AI, really automate it. In fact, in our own office, we have Excel macros driven models and reports. So that is definitely possible, but not AI. I don't think AI.
So with that, after listening to all the panelists, what we agree to disagree is that we agree AI-based or AI-driven valuation models can be taken to a basic level preparation, and the judgment part or the analysis part, the complex level part, interpretation part has to be done by the valuation. That is where the valuations can add more value into the valuation reports. So as we proceed along, I would also request the audience to have, if you have any questions, you can let us know so that we can ask our panelists. So we keep on continuing as and when you have any questions, if you raise your hands, then we can pass on the mic to you to take up those questions to our panelists. So we proceed further. So the next thing is that I would like to ask Mr. Girish, what are the risks of signing a valuation reports? And if there is not enough information, should we sign the report?
I think so. Let's look at what, again, given the topic today has been statutory. If I take a UDIL, valuation is categorized as an assurance report within the UDIL. You're giving an assurance of the value. Right or wrong, we will not debate it. As long as that is clear, then you're forming an opinion, you're expressing an opinion based on which somebody is relying on it. If you don't have enough information to form a judgment, you should not sign it. If even after giving certain disclaimers or limitations, you're still not clear about the, unlike an audit, we still don't have a clear classification of what a qualification is or what a disclaimer is, etc. in valuation. If you as a valuer are not satisfied that you're expressing an opinion on a value that you can stand by, you should not sign it. What are the risks of signing valuation reports is an interesting question. I think Grant Thornton can answer that question very well after signing UB's valuation report of the brand. I personally believe so the risk is of being humiliated, if you ask me. Because valuation is an as-on-date assessment of, same thing that I spoke about when I spoke as well. based on certain limitations, based on assumptions, based on data that is available, and form a judgment. And you list out all the judgments in the report. If any of those judgments go wrong or change, valuation is going to get impacted, it's going to get changed. And we write it in the disclaimer. We always say that we are not guaranteeing that value if any of these factors change. Nobody reads that, right? So the risk is of humiliation. If there is fraud or if there is negligence on the part of the valuer, then obviously as a practitioner, the RVO or whoever is the body should take that, more from a professional discipline perspective. I think those are the two risks according to me. If somebody comes and says, I invested based on your valuation report, which by the way is all correct, but I lost money, I'm sorry, that's not a risk that I'm willing to take.
Well, thank you for that input. So we move on to the next question. A follow-up question. Probably I'll ask Chinmaya to answer this. If the management tries to push to the desired value, how should the valuer look into it, or what are the steps one professional can take? How to guide this?
Sure. So to an extent, it's a little bit continuation of what I spoke as an example in my session, that management will always come with a strategy only to any professional. It could be valuation, it could be audit or anything. They will have some strategy which is opposite to our desired direction. So we should be very mindful for sure. And at the same time, we can also be mindful of their shoes. Like we can stand in their shoes and think. Then most of the things will be simplified as to why are they asking it, why are they coming, rather than going on a confrontational mode as to why are they telling me I will not agree. We may also need to think as to, because as a CA, we are always trained to look at a conservative approach. But as a valuer, if I am looking at a conservative approach, then I am definitely going in the wrong direction, because valuation is what is realistic, not what is conservative. Therefore, many times we may also be start to think in a wrong direction itself, and management itself may be correct also. But having said that, once we are clear that what we have in our mind is right and our thought process is in the right direction, then maybe in a few different ways we can approach. One is if something what management is expecting is not correct, then obviously it's an explanation to the management saying that why what you're thinking is not right. And when we explain them in a slightly detailed manner, these are the 4 aspects because of which what you're thinking is not correct, then maybe that we may get elaboration at least for the 2 aspects. We may get some clarity or additional information, details, and we may ourselves also change our mind to an extent. And after that, still if some of the points, if there are inconsistency, then definitely there is no go to proceed with in the same direction. What we feel is appropriate, we should proceed. But having said that, a few things which I have done in the past is, one is if both of us have a different view, but there is merit in what the management says also. We may have a different view, but there is merit in what management says also. So if it feels appropriate, we can consider that. And in few instances, what we have done in not only disclosure in the caveat and all of that disclosure, but still disclosure in the appropriate place is also very important. Like Girish was saying, there is no background material to understand the classification between disclaimer and other things. Because that is not there, we need to be ultra cautious in the way we are reporting. Possibly wherever we are, instead of disclosing in some background or something saying some information was not available or some shareholders agreement was not available for a review, like that kind of thing is there. Instead of disclosing somewhere in the background or something, disclosing the final value itself. The final valuation is so and so, but we had this limitation to this. Very standard example we have where we continuously do this is the WA valuation for income tax net asset price valuation. There are multiple points we will not be comfortable at all. It says that as on the valuation should be made as on the date of the transaction. Date of the transaction is taken place based on audited financials. So it is impossible to get audited financials as on the date of the transaction. Let's say 11th of May is the transaction date, it is impossible to get audited financials. These are the things which we have to mandatorily disclose, especially in the place where we are saying valuation. This is so and so is the value as per WA, but there is an exception, this is not as per WA.
So it becomes very important for us to be very cautious and put it across in terms of how we educate and make them aware of the process that needs to be followed. So moving on to the next question to Anjan. what things to be considered while reviewing the valuation report as a statutory auditor. So it becomes very relevant for today's audience, as many of us will be chartered accountants who are on the auditing side. And when a valuer gives the valuation report to a statutory auditor, in terms of them to adopt the opinion given by the valuation professional, what are the things that they need to consider from the perspective of the valuation?
So this can be answered in multiple layers, because again I think it can be a 1 hour session of itself. But on a broad overview basis, I think first is whether the valuer has actually done any exercise in relation to checking whether generally DCF approach is taken most of the places. So if a DCF approach is adopted, has the valuer done sufficient exercise to check whether these projections are alright? Okay, if management has given something, have they directly simply adopted it? So better is target some of the questions to the valuer which are business related rather than the valuation specific related, so that we get to know whether the valuer has exercised their judgment and their mind into this valuation. So that itself you will get to know, with the quality of answers you will get to know what kind of work has gone into it. So that is one of the important things, that is your ability to assess whether the valuer has understood the business. That is the foremost thing that the statutory auditor has to look into. So once that is done, then it's about error checking. To err is human, right? They say that. So it is very much possible that valuers may also have linked some wrong cell in the Excel sheet. That is very much possible. Accuracy related issues are there, and when accuracy related issues are there and report is also signed off and you have also signed off on audit, later it gets to know 2-3 levels of embarrassment will be there, both for the auditor as well as for the valuer. So I think the statutory auditor is a good bond over there to ensure such an embarrassment doesn't flow off into everything. So this is the second level. Third level is the judgment on things like comparable companies and discount rates. These assumptions, these has to be checked. But this can be very subjective, so auditor can choose to look at it whether it's generally reasonable or too outlandish. That is the only thing to keep in mind. Not to debate on 0.5%.
So thank you, Anjan. With that, there's a question from the audience. So
it's okay. I can wait out. So extending the same question, valuator has given his valuation report. The statutory auditor has also verified it. All looks okay. But then that is being challenged by the department. And the statutory authority is probably the income tax department. Because you would have done a forecast, by the time they have taken the report, it's actually become historical data. And they would compare and they say there is a lot of deviation from that. So how do you challenge that?
So let us understand when the department comes in, right? If you look at generally overall department wise, there can be income tax, ROC and FEMA. Okay. Both of them have different triggers where the statutory auditor may not be involved. But let us say for the limited purpose, Girish, you need to tell me if an asset is impaired, is the expense deductible? Or Kaushik, it's not deductible, right? Not deductible. So I don't know where in a situation, maybe ESOP expenses is one place. Anyway, ESOP as an expense is given by a valuer, and the whole premise itself, the department is challenging, saying that ESOP is not a expense that can be deductible. But High Court has told that, I think Supreme Court judgment has not yet come, High Court judgment has come that it is an allowable expense. So that's the only place where I am seeing there is an integration of the valuer and the statutory auditor and the department. And another one is PPA, which Chinamaya also took earlier, where certain assets can be considered as intangible assets. And goodwill is, you cannot take a deduction on it. So these are the only two cases. When it comes to these two cases, I'll tell you, income tax department can be extremely unreasonable. Whatever you do, that is what we felt. There was a recent judgment on Rule 11 UA, where first of all, the choice of the method, whether to go for that net asset approach or to go for a income DCF approach, get it signed by merchant banker, it is the choice of the assessee. But the department has gone ahead and told, no, this is hyperinflated, income approach is extremely inflated, we will go only with Rule 11. Now later on, High Court did reverse the ruling, but that is the kind of stance that they are taking. And the merchant banker's report was rejected by the income tax officer, but the reasons for rejection were so much of day and night between what valuation is versus the reasoning that has been told. So I'll tell you one example of the reasoning based on which the income tax officer rejected the merchant banker report. He told, in the projected period, the company has shown a very positive projection, extremely positive projection, but the actual performance was very tough. So that only shows that the valuer has not done a right job, and that is the merchant banker has not done the correct job. Now, from what angle can I start convincing the income tax officer, no, that is not how valuation works. We are not astrologers who can predict the performance of a company. We can only take a judgment on it. So I think there is a huge gap between the understanding that the fraternity in the valuation profession has on what valuation means versus on the department side. Everyone has their own objective. Income tax department, I felt, was extremely revenue aggressive in this situation. So if that kind of stance is taken, no matter which valuer does anything, they will keep rejecting reports until such report is in favor of the revenue. That's what that is my opinion. It doesn't reflect the opinion of my firm or the fraternity.
I just had a couple of things. One is, I think even recently there was an IT case over there. Eventually the tribunal said that you can't take projections and actuals which come after 3 years and then say that the valuation was wrong 3 years because assessment timelines stretch, right? So I think eventually courts will come in favor of.
But we are getting every day out of that.
Yeah, because
56 to 70, we are getting across the board.
yeah, last 3-4 years that's how it has been, right? I mean, from the time we realize that 56 to 70 is a cash flow, department is after that. You can't help. That does not reflect either on the valuer or the statutory. There is an interaction there, however, because if a 56 to 70 order is against the SSC and eventually he decides to pay, that should have been in tax provision. So the true and fair view of the auditor when he signed off is wrong anyway. So to that extent there is an interplay, but you can't really do anything. I don't think we should do anything else. PPA will not matter. PPA comes into picture in a consolidated financial statements. India is not assessing on consolidation, except in slump sale cases you need to be careful. ESOP, they should, they are not yet, because I have seen even in cases of fairly large unicorns in those cases, ESOP at the time of exercise, the valuation is undervalued. The same company would have raised funds 3 months before or 3 months later at a much larger value. Just to keep the employee taxation low, they undervalue the ESOP exercise price. It should come into picture and it should get debated. That's not happening as of now. Does that kind of give you a sense?
Yeah, my question was basically this only about 56 to 7B and similar cases where they have been taken.
56 to 7B department is wrong.
Across the board, the officers have been going that way.
Yeah. So the first 3 cases that actually got picked up across the country were handled enough. It was nightmare to explain to them how projections work. And after that, they took out the definition of accounting from the rule already.
I just had one point maybe to add to that. Some of the things how we can explain the income tax. Obviously, it's an enlightening session for them. For example, the projections we are talking about. After 3 years, what is there now they are considering? So the basic logics, like Anjan was saying, there is a day and night difference between the two. Some of the things which we can in simplistic way explain is what is the cost of capital taken. If cost of capital taken is 25% for a startup aggressive projection, why not we take 7%? So if you are saying that same revenue to be taken, then what is the difference between 7 and 25? So that kind of actual reason, if you put it across, many times officials get convinced to an extent when the difference is obvious, when the rationale is very obvious, like we have not taken 7% which is rate but 25, that's a very obvious thing. But 100% they'll not get convinced, but a lot of progress you can see in your assessment.
The problem has always been with respect to revenues and all. We have aggressive projections and the actual work.
And that's what I'm saying. If the projection was not aggressive, cost of capital should have been 7%. The reason why we have taken 25% justifies the projection should have been aggressive. If actually the actuals is in line with projection, then actual value is wrong by taking 25%. His judgment was wrong. We have taken high because it is high risk, and the projections it is rightly has missed the.
So that's the excellent answer, right? But at the same time, so if you see the department, their answer to transfer pricing has been brilliant. They actually sent officers to Netherlands, where there is a very reputed international tax institute. They got them trained. They set up center of excellence. So when you actually go for a transfer pricing assessment, you have fairly rational discussions with them. Fairly rational. You have a TP practitioner sitting behind you smiling, right? You have fairly reasonable discussions. You can argue why something should be filtered out, why something is not filtered out, and things like that. Which comparable benchmark. They are not had training in valuation. So that first 2 to 3 cases that I spoke about, when I spoke about cost of capital, I used to use the term discount rate. He actually caught me saying, where's the discount? You're not discounting the valuation. It's a joke, but the thing is, they're not being trained. So we can't expect them to know every single facet of every activity that they're supposed to assess.
They directly concluded saying that this is black money being routed. This is the direct conclusion that they draw.
Otherwise, you get noted under 63, 68, whatever that is, we go into that.
Just to summarize, so it becomes very important in terms of the valuation, the background approach as to how the basis and the assumptions have been evaluated by the valuation professions. So this will help us to safeguard the positions taken in order to establish before the judicial authorities it might be, or the income tax authorities, or any other investor community. So it becomes very critical that the process and approach deployed is very exhaustive and very clear in terms of the positions taken. So I have one more question from the audience, so we'll take up that before we proceed.
So I think one of my questions got answered over here. I have another question. So my question was, how well are the regulators coping with everything that's happening in the valuation space? I think Girish answered saying that drawing the parallel with transfer pricing, right? Similarly, in India, I've seen that they're very behind and they're catching up a little today, but not yet there. So one suggestion is maybe as valuation professionals, experts, you should look at maybe doing some kind of a training for the department. Right? That's one. But my question is a totally different domain. It's about, bubbles. All markets have bubbles, right? So you've got the equity, stock market, bonds, everything. And also, of course, the startup funding. So how well are the valuation professionals equipped to build in the effects of this bubble? And, again, as Anjan you said, you're not astrologer to foresee, to gaze with crystal ball, but at least be able to sense whether something should be baked into my valuation, and is there something more that can be done over there, and typically where would you kind of adjust it? Of course, the discount rate being higher, as Chinamaya said, is something which you probably would take in. But what are the considerations in a bubble market for valuers to be mindful?
Can I take this? Okay, so I think it's generally the word bubble is taken in a negative connotation all the time. That's how the housing crisis bubble or dot-com bubble, all of these are taken in a very negative connotation. I have a little contradictory view. I think bubbles are really good, and I'll tell you why. So recently we are going through this AI excitement phase. Critics may call it AI bubble, but it is an exciting phase. Few years back we went through something called as a crypto bubble, where everything that is related to crypto boomed. And I think the bubble also sort of burst with the way Bitcoin and so many scams coming up. It has burst. But if you look at history, let us take 70s as an example. In 70s, there was a thing called tronics bubble. It was basically cheap electronic goods coming out of Japan. Japan built its economy based on this 70s boom in electronics. But later on, what happened, what was inaccessible as electronics, 10 to 15 years later, electronics became very much household in every house. I mean, it became cheap, it became available, everything. Then 80s, the same issue happened. In 80s, what happened, this computer hardware bubble happened, where computers where being any investment in computer hardware was seen as an aspiration to be at, and at some point in time the bubble burst.
Basically the advent of personal computer.
Yes, advent of personal computer. Forward again, then what happened in early, because of the 80s computer bubble, 90s you have popular adoption of personal computer almost everywhere. 2000 .com bubble happened. Mid to late 2000s, .com became lifeblood of all world economies. So what you are seeing over here is whenever there is a bubble getting formed, why the bubble gets formed is people are excited to go towards it. People are excited to invest in anything that has got to do with it. Because of those investments coming in, lot of experiments happen, lot of failures happen, lot of successes happen. But those successes are enough to transform our world in a way that we could have never imagined it to be a regularity, whatever technology that comes or however it is, right? So whenever we feel like we are in a bubble, I usually take a view of whether this is that company that will be that success factor. So why? Because many times when bubbles happen, you can just have a shell company with a new founder having $1 million valuations. That is something we have to see what resources are coming into place to actually make this one among the 100 people that will succeed, or will it be one of those failures that got failed in the bubble. So there is nothing, I wouldn't call it as an acute, but rather being extremely aware of in this particular situation, what does it take to be a success factor. Like today, if in AI business you have to be a success factor, you should really be having good access to chips and semiconductor if you are doing internal development. If you don't have that, there are a lot of companies out there that are having 2-year waiting period to get chips from Taiwan and TSMC and South Korea. So Samsung and TSMC, there is a long waiting period. So why would they, in their business projection, how can they consider that they will get chipsets in just 2 months or 3 months? So these are the kind of industry insights I think one valuer should have, especially in cases of bubble.
Is there any other view from our other panelists? Chinamaya and Girish?
I have an additional point on this. One is I completely agree with the view of Anjan in looking at the bubbles also in a different way. Like I was saying, we should not always look at conservative way. We should look at realistic way, which includes positive as well. And the other thing is, many of the inputs in the valuation, if let's say either it's a market approach or also an income approach, if you take for example, the valuation is for next infinite amount of period. And while the bubble may be there for 1 month, 6 months, 1 year, 2 years, or maybe 3-4 years, or maybe a recession could be there for a temporary shutdown and then come back. Even though we may be valuing a company during the time of recession or during the time of a bubble, but the valuation is for a very long period. That's why we should be, we should be conscious that our assumptions, what we take, is already that includes the periods of low and high. One example is even the way we compute discount rate, for example, which is one of the foundation for valuation. So in the discount rate, whether I am taking the current, let's say Nifty or BSE 200 index, whichever index I take, whether I take current one or the 5-year one or 30-year average. Sometimes we used to think that 30-year average, but again average for last 5 years backward, every 5 years, 5 years, 5 years I take average. So I am covering every down and up. At the same time, I am not influenced by the original growth, which may be very high. So likewise, we go very detailed. I mean, in our generally we keep doing this research whether this input is right or there is any improvisation in this in the way of computing this input. So there we need to be conscious that we are not influenced by this one of the bubble which is there. We should adequately factor in all our inputs to ensure that the valuation is not just influenced by a bubble but with a larger economy.
Any points from Girish? Go ahead.
I think what Chinamaya and Anjan have covered. So I think knowledge of the industry is most critical. So if you don't have the knowledge of the industry, you will not factor that into your alpha. You will not factor that into your projections. So very important for the valuer to try and understand the industry, see whether the market analysis, whatever is built. I mean, if some companies predicting a 25% market share, you know that they're smoking pipe, right?
So it becomes more relevant that just becoming a valuer will not help, but become industry-specific valuer so that you have more domain knowledge or the industry-specific information. If you are in a health tech sector, it has a lot of things in terms of how the R&D, pharma, the kind of the valuations trigger. That has its own aspects to be covered. Like how all of the panelists were telling that it becomes very important as to have the industry knowledge. So similarly, valuer will season out based on his valuation approaches from different industry. So that is the key point of takeaway from this discussion.
So once you, last point, once the valuer's bill comes in, once you start actually, don't look at valuation as a goal seek, but an actual price discovery process, right? Like investment bankers already have industry specific specialists who work in that particular industry. Valuation also will follow that route. They're actually doing valuation. They're doing a better job than us because they're fixing the price and they're fixing the value for more.
Yes. So moving further, I would like to ask Anjan's inputs on this next question. Allocation of value to different class of shareholders, which was the topic that you handled in today's session. So the challenge there, what we come across usually is that when the previous valuation is not available for a recent date for considering the implied equity value, but it is available tracing back to 1 year or 1.5 year old related valuation date. So what is the ideal way to consider the implied equity value? We rely upon the old valuation value, or is there a need for to redo the entire valuation activity as on the date of the allocation of value to the shareholders?
So generally valuation is, let us say, beyond 6 months, 7 months, it can get not reliable. But here's the thing, right? 1.5 years back, if the company was a different beast altogether and today it's a different monster, I don't think we can definitely not adopt it. But it also depends on what is the purpose of your valuation. Your purpose matters. Like, for example, let us say you are a fund house that is tracking your value of your portfolio. For you, it actually doesn't matter whether intrinsically the fair value has gone up or not. All that matters to you is whether the company is having transactions or not. So if the company has not had a transaction in 1.5 years, for the fund house, then nothing has changed. For the fund house, the old valuation is what it is. Yes.
So the takeaway is that we'll have to see from the perspective of the assumptions and the business position at the valuation date 1.5 years back and the current date will have its own bearing to whether to assess for a new valuation report or not.
And also, if you're assessing for, let us say, investment impairment, you should only look whether the company in which you're holding investment has significantly come down in its operation. Then you will have to do a fresh valuation. Otherwise, for even testing of impairment, I don't think you have to do any other new valuation.
To take a follow-up question on this for Girish, in terms of a similar situation where the allocation has to be done, but the downsize is happening in terms of the business progression. And the ideology itself, the investor is coming from the perspective of looking at I am ready to invest in the business only for the team but not the idea that you have. So I will give my own different ideology after acquisition. So when there is a downsized valuation that is happening, but in the last 6 months there is already a higher value implication, how would the regulatory framework look at it? In terms of, is it permissible for the investor to come at a lesser value compared to the earlier valuation rounds, where the earlier investors are ready to get this dilution?
Actually, regulations are not trying to meddle with that downsides, down rounds and things like that. Because as it is, it's so difficult to operate. I mean, the way venture investing works and valuations work, it's become difficult to work that ways. If regulation starts having a view on down rounds, it will become even more difficult. I don't think, I hope they will never get into that discussion. But to answer your question slightly differently, the fundamentals of the business has changed. If the previous investors are willing to take, I will give you an example. One of our clients was in a sort of a consumer-facing business of an aggregation. They were valued really high. They were actually at some point of time close to $1 billion valuation. But they changed their entire business model. Their entire aggregation business went away during COVID, and they became a manufacturer of whatever they were distributing. I don't want to go into more details. Now, fundamentally, the company shifted within a span of 2-3 months from being somebody who would touch 20,000 human beings every day and collect revenues of about 100 rupees, 200 rupees, to a company that touches maybe 300 individuals a month at a ticket size of 2 lakhs. Obviously, it has to change. Whether it was 1 month, 3 months back, you have taken a valuation of amount. So, I think that should be the approach. Downward protection, valuation of downwards or upwards. Thankfully, the regulators are quiet. Otherwise, guys in Babu, guys in Origo would have had serious issues.
Because the investor fraternity or the consultants look at this as a roadblock from the 56 to 10, where the buyer or the investor is buying at a lesser value when compared to the earlier valuation.
The only saving grace is that 56 to 10 is NAV based, so it sets the floor. Second is that 56 to 10 won't even come into picture in some of these examples because they came as a primary investor, and therefore 56 to 7. So therefore, it's like you kind of navigate through.
So with that, we'll move to the next question to Chinamaya. In terms of purchase price allocation, how does the challenges in terms of reconciling the WACC and VARA and IRR plays an important role in purchase price allocation?
That's actually a very, very big challenge. I mean, big challenge in the sense, a lot of time-consuming process. Because firstly, like I was saying, convincing the management to provide all the information to, do a good job on the PPA itself is kind of an exercise. And moreover, asking them more questions on individual asset. For VARA, you need return of the individual assets. So it will make our exercise much more in-depth detailing. So that is one challenge which anyway will be there in all the engagements, more so in a PPA exercise. Other than that, this is it's not as very simple exercise. For example, even just to give the background between for the question of WACC and IRR, the question is for the benefit of audience. Cost of capital, WACC is the cost of capital what is taken for valuing the particular IP which we are valuing. That is one input, and the second input is IRR. IRR is general business, the business of that either CGU or the company. That company, when if we do valuation for the set projections, what is the IRR which we will give? That is the second input. Third input is VARA, which is weighted average return on assets. So other than the subject IP, whatever we are valuing, other assets which are there, what is the charge or the return possibility for that asset? For example, if it's a fixed asset, maybe depreciation rate could be a right corroborator for the charge. If 15% depreciation, then 15% is the return expectation from that asset. Like that, we need to determine the return on each of the assets and then take the weighted average. Then we will arrive at the number. All these three numbers should be right theoretically. And practically also, once it is theoretically that should be right, in practice we should ensure that that should be right. Many cases it will not be right in the first cut when we work on it for various reasons. But however, we should ensure and find what is the possibly gaps or slight modification in assumptions, everything we should make in order to bring alignment in these three numbers. It's one of the important milestones to be crossed in an IP valuation.
That is a pretty complex thing, but we'll have to ensure that this is taken care in terms of the client interaction and getting additional data to perform additional activity and get this data reconciled. Moving further, did you have anything to add? Moving further, I would like to take this question to Girish again back. In case of private limited company, can right issue be done at face value without attracting section 56?
If it is at face value, 56 you won't get attracted. The starting of 56 to 7B is, it says whenever the company in which public are not substantially interested issues shares at a premium. So if it is not at a premium, it will not get attracted.
So face value for right issue can be done when the earlier rounds or other types of private placement are done at premium.
Section 56 perspective, absolutely yes.
So
But there the economy there, however, is companies are touching doesn't even require a valuation for rights issue. Even if people are waiving rights and you are issuing it to somebody else, you can sort of slide through that. But you'll still get caught in 56 to 7B there.
So it becomes very important that when it is straightforward, the rights issue is not renounced and rights issues are given in proportion to the existing shareholding, then it does not attract any challenges.
It's a face value 56 to 7B will not even create a nature.
But what I am seeing is in terms of when the rounds of investments happen in terms of different values, private placements, after a certain period, let's say after 1 month or 2 months, immediately rights issues are being made and rights issues are done at a face value.
Face value or a lower value.
Lower value. So it should not have any impact. Okay.
That's exactly what has happened in some of the transactions that have been, today anecdotally we've been talking about OYO and Byju's. Both of them have done rights issues at lower values and the investment values that have happened a few months before.
Will the income tax authorities not question this transaction that the investor has got the benefit of the difference of the previous value and the current value? 56 to 10?
Thankfully, the same formula and the constraints that apply to us apply to them also. They don't have, see, if you are the tax expert, as long as there is no methodology or computational, computational methodology defined in the act, you can't do anything.
Charging section.
Not just the charging, also the computation mechanism.
Also in this case, even if it is at a premium, if it is right without renounce, either way it does not make any change. So even if it is a downward valuation also, it does not make a difference. That's what I think. So even if income tax department want, they cannot challenge it. Because none of the parameters change.
They can only question the valuation itself, which actually they should not question.
That also cannot matter.
Because they don't have the right to question.
Only if there is a renunciation of right, then things get complicated.
With that, we'll move to the next question to Chinamaya, to Anjan. This is in case of ESOP valuation. When options are granted to the employees with a perpetual exercising condition, how does the life of the option be considered for valuation purposes? Because there is no predetermined period telling that after 4 years they can exercise or 5 years. It is a perpetual thing. And I have second question when we come to that, and that is related to this, where management will insist on the period, telling that you consider 5 years or you consider 4 years. So it is perpetual. As a professional, we know that it is not a pre-decided time period of 4 or 5, but management insists to consider this assumption in the valuation process. So how does these situations be handled?
So let us understand why in the first place perpetual ESOPs are given without a definitive exercise period, right? If you look at it, the tax that the perquisite tax that has to be borne when you exercise an ESOP can be quite a hit on a salaried employee who is taking home a certain amount of salary. So these perpetual options are given so that the employee can find either a comfortable time at which they can exercise, where they can bear the tax cost, which in most cases they will not find a comfortable time to do it. So the other way is to facilitate, they will facilitate an exit when sufficient number of employees have reached the vesting condition. So usually that is when we need, as valuers, we need to ask, when do you intend to exit your employees from the cap table? because everyone will have that intention, because that's a good chunk of 10% in the cap table. So they will have an intention to exit them at some point in time. So we, as valuers, we need to ask them what is their intention. Maybe in the next round of funding, they can get exited and the incoming investor can get in, or if there is any plans of acquisition as per the business plan of the company. So we can consider a time up until that time as a period of the option, as a life of the option. And management, anyway, they will insist on lot of things. We have to take an independent judgment. We have to balance what is the right thing to do in financial reporting, as well as the interest of all the investors. Keeping in mind that also we need to take a judgment.
Then can I follow up? Yes. So one is the intent of the management. Second is, what I have personally done is, you will have some kind of indication. See, whenever management is insisting on something or they have a viewpoint, it's not called insisting. Whenever they're insisting, there's a problem. That's a different issue. But if they have a viewpoint, it has to be backed by some kind of comparable that drives you towards that conclusion. Either industry-wide, companies are doing buyback every 3 or 4 years. The bubble that you were talking about, buybacks were very, very often being conducted on employee stock options, or they would forfeit the options and actually get a cash bonus. So there was some kind of history built up in terms of saying that if I have granted an option 3 or 4 or 5 years, whatever it is a good time. That's one kind of benchmark. Second benchmark I have used is, especially in developed markets, there's a benchmark of when a company gets funded on a Series A, which means there's at least a product market fit. There's some kind of traction to when they go IPO. For example, for Fitbit, it was 12 years. I'm using Fitbit because I use that benchmark in a health tech company to say that they took 12 years. Indian market, Indian situation, maybe these guys will take 15 years. So 15 years gives you a time period for potential exit. So you take that long period. You can't anyway take perpetually. At IPO anyway, everybody exercises. Either this or that. So some logic should be there.
And another logic, in fact, my thought process got kindled when Girish also was speaking. You have to look at the seniority level of the employee. Someone at the CXO level, they would want to take position in the company as soon as possible because they will want that voting right in the company. So they may exercise as soon as the vesting period is over. But someone in the mid-level employee, they may just be in it not for the control part of it, but also for the economic, just for the economic part of it. For the economic part, whatever we both spoke.
Or is it better to have the probability model and then run a Monte Carlo simulation?
It's too much. I mean, if you are dealing with a listed entity that requires immaculate accuracy in this thing, and ESOPs are a very material part of it. It's a very remote chance.
There's a startup-based company that it does not make.
So I was going to answer in similar lines to what Anjan said, but overarching answer which was spoken about at the beginning of the discussion. Valuation is an estimation. Any estimation has to be one of the fundamental principles of accounting. Cost versus benefit has to be matched. In all of these other customer values and things like that we are doing, I spoke about valuation can be 1.5 years old, 1 year old, 2 year old. If the only instrument you are valuing is a small share warrant, and 100% change in that is not going to have a material impact on your valuations. Are you really going to go and do another TCF, align that value, do the entire transition point based allocation of value, and all of that? You're not going to. Why? So that is the biggest challenge for us to convince auditors is there. We keep telling them, see the materiality. Don't question me why this 1% here, 2% here.
Okay. So that becomes more important to see the relevance and the appropriateness of adopting material impact.
One more point I observed when you were saying, your question, it's very much accurate in multiple other contexts of management asking us about this, right? If management is saying that, okay, the exercise period is let's say 10 years, but management is asking us to take it as 4 years. Especially in valuation, we should also understand the limitation as a valuer also. It's not necessarily that every possible document of the company we would have verified and then take a position. If exercise period is mentioned in an ESOP scheme, And if they're saying that, okay, you take it differently, first of all, I don't need to even see the ESOP scheme. It's not in my purview unless I feel it very material and very obvious without wishing that it will too much differ. In fact, then I may choose to ask it. Otherwise, I may choose not to see the ESOP scheme. And we can might as well go on the representation given by the management that these are the salient features of the ESOP scheme and let them give the representation if at all they want. I'm giving a practical way out. Let them give the representation instead of giving the scheme itself to us. And we are okay to consider what is. They are agreeing with
the approach to not to make it more complicated.
It does happen, right, practically. See, in India, you need to have a ESOP scheme approved by shareholders, etc. I'm currently doing an engagement where some Middle East-based company has given commitments in their employment letters as saying that they give 1% of the company valuation. I mean, shares worth 1% of the valuation of the company. Correct. That's all it is. There's no grant letter. Which valuation? We don't care. 1% at what point of time? Not clear. So unless you get a representation and you have some kind of consensus with the employee and you know you're going to account for that as a liability, you have to go by that, whatever is the best data available.
Moving on to the next kind of question to Chinamaya. What is the view on tab benefit for customer relationship? Since there exists difference of opinion amongst the auditors. So is it considered or not considered in case of valuation of customer relationship?
Maybe I'll defer this to Anjan, he has more.
So tax amortization benefit on customer relationships.
Correct.
So Chinmay also had told when it comes to classification of intangible assets, customer relationship emanates from PPE, acquisitions or something, right? So there is a 2-point check. Is it a contractual thing or is it separable? These are the two tests. If it is a contractual relationship and this contractual relationship cannot be transferred, like let us say I have certain customer orders. This is not customer relationship, customer orders, and let us say I cannot give it to you. Then obviously it's not a transferable asset. So invariably you cannot take tab in this case where it is not transferable. But if customer relationship is transferable in nature, where I can create an intangible asset, I can park all these customer relationships in a different entity, get the ownership of the entity changed, and then obviously this is transferable. So once it becomes transferable, obviously I can take tax amortization.
Moving further, we have next question. Where there is a transaction already transpired between the investor and the company. Later a valuer is approached to support the valuation. How would the valuer approach these kind of situations, keeping regulatory framework in mind? I would take the view of Girish in this please.
So I'll first give a serious answer. Right. So again, we always have this dichotomy between value determination and valuation from a regulatory perspective. Regulatory perspective, the valuation has to be done, the report has to be issued, it has to be at a particular value. In fact, given 3 or 4 regulations are continuously looking at the transaction, you have to essentially pinpoint and say that this company is worth 1.67 crores up to the extent of 3 decimal points. Right? Practically, that is not going to happen. Number 2, whether a management is insisting on an exercise period or a management and an investor have agreed on a value or not, as long as it's an arm's length transaction, we should also think that there is some kind of rationale in this and there's a unbiasedness to the whole transaction. So if somebody has determined the value of the company to $1 million, it is possible as long as the cash flow supported, the market model, whatever they have built supports it, we should be able to be guided by it and therefore make appropriate changes to our assumptions to come close to that value. I think that is the exercise that we are doing. We have to do it. On a more jovial note, most of the regulatory valuations are goal seeking engagements. I'm being as honest as possible. Because if something is already got determined, legal contracts are drawn up when the assignment comes to me. I can't now go and say that no, it's not $1 billion, it's actually $2 billion. It doesn't work that way.
I think one point to keep in mind is your client selection. If you Girish was seeing the example of Jagan's company, which is having so and so values, like where there are, I mean, hundreds of things may be possible. If you know that there may be some kind of issue may be possible, I think it's best to avoid, especially this.
I should have said that myself. It's an absolutely correct point. When the investor is a VC, or institutional investor, or a very well-known angel investor, when the promoter is a technocrat, IIT, when he's saying I build robots, you can actually believe that. Versus, I had a situation where somebody came and in his past life was a real estate developer. He said, I'm going to manufacture the world's cheapest mobile phones. And he wanted a valuation of 150 crores. So I said, I'm sorry, I can't do it. Right? So, but once I've determined that this guy actually can do, he knows what he's talking about, there's something that's already gone, investors are credible people, then I start on a slightly different note.
It becomes very important to say no sometimes in terms of the client selection and take only what is valid and genuine. Moving further, in case of terminal growth rate, in case of a pre-revenue company, for a valuer to assume certain terminal growth rate is a leap of faith. Because bulk of the value is lying in the terminal value. How should one take care of this? How to approach or how to decide a terminal growth rate?
Pre-revenue companies.
Right.
See, pre-revenue companies are very interesting to value because you are literally building castles in the air. So this is one example I'll take from Ashwath Damodaran's book only, because I was also quite puzzled on how to really approach valuation of pre-revenue companies. Of course, VCs, PEs and angels, they take a completely different approach to taking positions in pre-revenue stage companies. They basically look at, will I get an exit and will I get a 5x to 6x exit. As long as that parameter is met, whatever valuation is there, it should backward work towards them getting a 5x to 6x exit. This is practically how it will work. But when it comes to this traditional discounted cash flow models, they are actually not really primed to do such valuations. But if we have to do it, then we will have to project the company till the point it reaches a certain maturity level. And Ashwath Damodaran, what I was trying to refer to earlier, was that he looked at if Amazon were to be valued back in 97, 98, when Jeff Bezos was still in his garage, how would you go about it? So you speak with Jeff Bezos, understand what he's trying to do. He is not only just trying to be a buyer and seller of books, but rather he wants to get into everything, A to Z. That's why he called it Amazon, right? So he wants to get into everything. So at that point in time in 97, 98, there were only two players in the market that was buying and selling almost everything, which is Costco and Walmart. So Amazon, that means, aims to become something like Costco or Walmart. Back then, Walmart was valued at close to $10 billion back in 97, 98. So then what Ashwath Damodaran did was, okay, if Amazon is going to be like that, how long would it take for it to get there? It may take 10 years, 15 years. It may, Walmart took decades to do that. Amazon may do it within a decade or so, or within a decade and a half, because it's leveraging internet. So if you first build the conviction that internet is going to work, and then it can create such a possibility to build a size of a company that's as big as Walmart, then this is very much possible. So then you know your starting point today is 0, and you know your end goal is $10 billion. So in between you have to build the projections and you have to do it. So terminal growth rate, that means ultimately coming to your question, terminal growth rate 10-15 years later will be the normal growth rate.
So we'll have to normalize until the projections, business is getting normalized, take a longer period of financial projections, and then have a normal terminal growth rate rather than keeping it simple 5-year projections.
And it's also not just the length of the projection, it's about
Business cycle.
the story.
Business cycle.
No, cycle also may be difficult, but that story that the promoter is trying to write, a very good pulse on it should be there with the
just to add, it is not only startup or a very pre-revenue startup, any company for that matter, the explicit period should be up to the end of the growth stage, and only the later should be the terminal value in all the companies.
And we have these band-aid solutions like hedge models and all. If you are not able to project beyond 5-6 years,
high growth stage and then the non-growth growth stage. So just a follow-up question on this, is there any indicative guideline in the industry in terms of what should be the overall valuation percentage in terms of the explicit growth value and the terminal value in terms of the overall value? Let's say if the overall value of company is 100 crore and if that 100 crore is coming out of the terminal value only of 80 crores and 20 crores is coming from the explicit cash flow period. So that is 20% of explicit cash period and 80% from the terminal value. So is there any indication for to see in terms of the benchmark, like how we were seeing in the morning in terms of how an intangible or a tangible proposition should be there in different sectors? As an overall approach, is there any guideline or is there any industry best practice or observing guideline in terms of the proportionate of value that can be there? Anybody from?
So I have not come across any such guidelines, but a mature company, if you're talking about a mature company, it is different. If you're talking about a very early stage company, it's different. If you're talking about a very early stage company, maximum value should come from the terminal period. But what I have seen is many times valuers, what error they do is not to consider the explicit period up to the growth stage, up to the completion of growth stage. Okay, standard is 5 years, so you take 5 years and complete the valuation. That is when the terminal value will be much more higher than what it should be. But ideally, it should not be too high also even in an early stage company. But it should be higher for sure than a mature stage company. But this error we should be conscious that the explicit period should be considered appropriately. Then that much difference would not be there between early stage and mature.
In that case, to say if there is the projections not being taken into the appropriate period of growth period, then it could end up in negative value of explicit period and probably fully more than 100% value coming from a terminal value, which might not be right. That will indicate outright that the approach is not right.
I think that as an apparent error. Anyway, it is error, but if it is negative, it seems like an apparent error.
Okay.
it can happen due to capex and all. That means the projections wouldn't have been done. So that's what even Ashwin Damodaran tells. If most of your value is coming from terminal value, you are probably wrong. That's what it tells. So that is definitely a red flag to look into.
Right, let's move on to next question in terms of in case of a purchase price allocation where brand valuation is, there is a disputed brand that claim is put up by a third party in terms of the IP or the usage of the brand by a third party claim. So do we assign a value for this brand or do we ignore, or how do we proceed in terms of the revaluation or what are the stand taken in these situations?
So every kind of advertisement is advertisement. So because the case is there, it is all the more reason that is very important. It is very valuable. But having said that, definitely that is something needs to be considered. What is the merits of the case, which side it may go. I mean, at the outside, we should not just take it as, okay, there is a case going on, so there is no value in this. There is a case going on, that's why there is definitely value. But we only need to see the merits of the case and which side it may go. Rather than, legal documentation scrutiny will be all the more important in this valuation than anything else.
But we will not be experts. Nobody may be able to say where the application is going to go. Cost of brand development and brand defense has to be built into that model. Whatever model you are building in when you build that valuation. Whether there is a litigation or not, you really should have some kind of cost to maintain that brand as well. You should build it into your models. Right? So this also should be part of it.
So moving further, the next question is to Anjan. In the process of valuation allocation, we see that there are challenges in how one has to consider the ESOP pool or options granted to various employees. So when we go on to allocate, whether the pool to be considered for allocation or how do we look into it. There's a difference of opinion. Certain set of fraternities say that ESOP pool will be considered only when it is vested and it is exercised. Otherwise, if it is just granted, they want to ignore it. And from the investor community, they say in terms of the dilutive value, they want to consider that the entire ESOP is being, as if it is vested and exercised, you consider it in your dilutive model. So what is your thoughts on this?
So in equity allocation, I think the answer is quite straightforward. because when you do a backsolve method or an option pricing model, you need to know when the potential exit is possible for the company. So usually in a potential exit, see, it's like by that time most probably the vesting conditions are met. But if vesting conditions are a little beyond,
based.
no, not performance based. Let me take performance based is also quite straightforward, because performance based will usually be revenue achievement or your valuation achievement. So 3-4 years later, if let us say 100 crore is the revenue to be achieved and only then you get a vesting, in your break-off points you get to know to achieve that valuation how much revenue you should be having. Like if you achieve a valuation of 400 crore and your business is, and at 400 crore is the break-off at which, let us say, employees will get, ordinary equity shares will get a payoff. You will know 400 crore is the break-off point, 100 crore is the revenue to be achieved. With 100 crore revenue, 400 crore valuation is possible because the industry is at 4x multiple. Then obviously ESOP is exercisable. That is on the performance based. In terms of time based also, your vesting period and the exit assumption that you have done should match up. So this is the where on this thing. And also usually what happens is, let us say there is one particular employee and they have certain ESOPs. Let us say they are close to the end of the vesting period, or it was a graded vesting and multiple years of vesting has happened, only 2 years of vesting is pending. The incoming acquirer may take the view that we can even acquire their shares, we will take off their ESOPs, convert it to equity shares and take a position there. So that depends on the situation, but if you don't have such minute level information, you just match the vesting date with the exit period assumption. And in the break-off points, you take the ESOP to be exercised when it is profitable for them. Exercised.
So the next question is to Girish, in terms of valuation report issued in capacity of a charter accountant for FEMA purposes, and he is also a registered valuer, and he issues another report for RB for the Companies Act purpose. Is there any conflict of interest in terms of handling the same kind of assignment under 2 different statutes?
I don't think there's a conflict, because we have issued it. As long as you're not issuing reported 2 different values and 2 different assumptions for 2 different purposes. Many cases where we issue, I issue it on the same letterhead with, I issue basically one report with both the connections and sign. So I think as long as you're issuing the same report for the same company with the same.
So it's all same, but only thing is whether is there any restriction to issue 2 different, because once I've already issued under CA capacity, will I have a conflict to do one as a RD capacity?
I personally don't think so.
I guess basis of valuation should be same.
Everything is same. The question here is there any conflict? When we say like, when I'm doing an audit, I'm not able to do an accounting. So when I say that, so similar kind of conflict.
A conflict exists when you've taken a position and you're forced to take a position that either audits that position or takes a contrary position to that. I can't audit accounts that I'm prepared. If I'm issuing a valuation report, I can't audit the company that uses that valuation report in any capacity, because I have to assess that valuation report. But when I issue a valuation report itself, in capacity of a CA or as an RP, I'm not conflicting my position. In both the cases, I'm expressing the same opinion.
So the regulatory also cannot question this?
I haven't questioned so far, thankfully.
Right.
And there is no provision as far as I know.
Yes. So I think since they have allowed both multi-professional practice to be taken up, I think they also cannot question in terms of actually conflict. Moving on to the next question again back to Chinmaya in terms of purchase price allocation. Deferred tax asset and deferred tax liabilities, is that need to be reported in the process of purchase price allocation?
I don't think so. I'm thinking for the first time, in fact, because whichever methodology we look at it, deferred tax is never a influencer because it is anyway fictitious asset. So I don't think whichever is methodology we use, deferred tax would be an influencer in valuation. So any other views? I'm thinking this for the first time.
Two, three ways of thinking about this, right? So when you do a purchase price allocation, what are you doing? The acquirer is paying 100. I'm also thinking when I'm saying, so if I'm wrong, I'm wrong. An acquirer is paying 100 rupees to acquire shares. That 100 rupees worth of shares is represented by some real estate, some other tangible assets, some accounts receivable, some other non-financial and financial assets. And there's which also, and what is deferred tax asset or a deferred tax liability? As far as the acquirer is concerned, he is acquiring the shares of the company. And let's take that example, not a slum example. The company still exists. In a situation, in an Indian situation, that company still exists. It continues to file its own tax returns. It continues to realize or not realize its deferred tax assets. And it continues to pay for its deferred tax liabilities. So it is a real asset or a liability as far as that company is concerned. Like here, I should take a deferred tax asset in my purchase price allocation at the same value. I also test it out for realizability. If somebody has created a deferred tax asset for carry forward losses in the projection code, I'm not supportive of that, then I should consider it. Otherwise, I should allocate value to that as part of the normal balance sheet assets.
And you have any point?
I think Girish covered it. I don't know if I heard it properly or not. That once that more than 50% acquisition happens,
to that point.
So exactly.
Yeah.
So if the asset doesn't exist
Correct.
by law,
Like you said, when you test
carry
it,
forward loss doesn't exist, then it's not there.
when section 79 comes into picture where the acquisition is more than 51%, the carry forward loss benefit is denied. And
Correct.
I think largely deferred tax comes up because of depreciation. Carry forward depreciation is still allowed, unabsorbed depreciation. So to that extent, it can.
So that adjustment has to be done to that extent of what is allowable and what is not allowable. Moving to the next question. In take of backsolve method, the discount on lack of marketability applied for derived value of equity per share, justifiable and how relevant it is. So let me explain this in a little more detail. Once the price is allocated to all the different class of shareholders, we get the equity value also, which is the allocated value. Is there any something specific again we'll have to add the DLOG to that arrived value? I've seen in some cases that is being done. So is that justifiable or how relevant it is?
So I think you are talking about a situation where a primary or a secondary transaction would have happened and you are taking that equity value, right?
Correct.
Okay. So here's the thing, Kaushik, when we adopt that transaction value, we should not adopt the equity value at the total equity level that is getting established. Like let us say Series C CCPS happened, you take only the Series C CCPS number. Let us say it happened at 80,000 rupees. You take that number, you build off the complete backsolve model. Now you do trial and error with the total implied equity value such that you will get 80,000 rupees for Series C CCPS. Okay, you do a lot of trial and error to arrive there. Now the thing is, if Series C CCPS is enjoying some separate control related rights, you build that into the formula of DLOM and DLOG. Like some additional voting right is available or some drag along tag along right is there. So those will provide if only this class of CCPS has that and remaining class doesn't have, then build in a higher discount on lack of marketability for other classes. Like Series C has a drag along rate and tag along rate, but Series B, Series A doesn't have it. You build a discount for Series B and Series A. Or Series C CCPS holders are getting board composition rate. You build a discount for Series B and Series A by taking 80,000 for Series C. Or Series C is having some disadvantage while other two are having an advantage. Build a discount into Series C CCPS. Do trial and error until you get that exact 80,000 with the discount in place. With the discount in place, you should still get 80,000. So yes, per share level basis, you need to take a discount and lack of marketability or discount and lack of control.
But I've seen through what I understood from your inputs is that factoring in this discount and then arrive at that 80,000 value. But I've seen once it is arrived, 80,000 is arrived, and then they take that particular class and then straightforward absolutely apply the 10% deal off and then leave it there. They don't again rebuild that into the 80,000 pricing coming back. That is one difference that I saw.
If 80,000 becomes 72,000, it's not a good thing. Discount should be.
No, that 80,000 will remain for that class of share, but when it is another class, let's say equity. So let's say an investor has invested both in equity and CCPS. So his investment was at 500 rupees probably. After that, there is rounds happened at 800 and 900 also. So 900 is the latest. So we will take that 900 for the purpose of implied equity value and then arrive at the value allocation. So let's say the equity value comes at around 700 rupees after allocation of the value. Now the percentage of holding by the same investor in both asset class is very less. So to that extent, the logic that the valuer is willing to discount again on the equity derived value is 10% is what they justify. So is that relevant is for the actual question?
You need to build in the discount into the model first, then do trial and error to arrive at the value that happened. If you don't build in that discount and later you add a discount, it will give an error in your implied equity value will be wrong.
I don't believe in doing the discount on lack of marketability after that, right? You are using CVC value, for example, to compute your implied
Right.
Now that CVC value at which you actually issue shares to investors is an absolute price.
Yes.
That flow is built in the discount for lack of marketability. So the model already implied the value already includes it. Why are you doing it? I have done it before. I made that mistake before. But I realized that why double dip the whole thing? And why do you do that equity valuation? For ESOP or for some other option that you would have issued or something like that. That Elon is already built into that model. Why double dip that? You will actually be understanding the expense on the company.
So that was the clarity that there are two schools of thought. That's what like Anjan said that
We both told the same thing, I think.
You said the same thing.
but we should build it into the
I have a
model.
little more basic in mind. So you have to do a thumb rule test too.
Correct.
See, many times what happens when you start, this is the thing with forest and woods, right? From a valuation perspective, we have so many models, so many Excel sheets, so many kind of things that we can actually build in. If you start building in all of that, you actually lose sight of what that value is.
So that's that we are moving to the end of the panel discussion. Is there any questions that the participants would like to have before we conclude in the last question that I am supposed to have?
I'll just go with one more question. So, I think we've heard various things since the start of the day, and Kaushik, you mentioned about art and science and knowing the client's business, industry, etc. Anjan just spoke of the story what your client has, right? Now, when somebody talks of story and art and science, there are two aspects. The science aspect is highly quantitative. How you can verify the numbers and all of that. The art part of it and the story part of it also involves a softer side, which is things like your intuition and things which you can't really test in quantifiable terms. And one of that is governance. Right? So how do you bake in governance? Because we've seen companies where overnight there's some governance issue and it just drops, or it just disappears. Right? So should a valuer consider that? How do you consider that? Or do you put that as one of the disclaimers and just show it?
I think you should look at it when you accept the client. After that, you can't really factor governance into the valuation.
You can't always find out.
It's a contingent in nature, or it is not even
accepted.
I agree.
But you have a valid point.
So, in any case, you have enough number of disclaimers that we put in. Even your certificates, etc., or the SRS and whatever, it has its disclaimers. Client is expected to maintain control systems, governance that actually relate to all the businesses, including accounting records, the general governance and so on. The same thing applies. Valuation is an accounting record at the end of the day. So you can't. I don't think there is any model that will help you build a model that will hypothetically value Tata's more than Reliance. If you were to go by popular anecdotes and governance.
Well, to some extent, it could be inbuilt governance also, because, for example, if you take Baiju's example, did the valuer miss out that governance misplaced would be, but however, Byju's when it was valued at the early stage, I mean already the, let's say, cost of capital is much higher than I would take it for a Tata listed company. So it's an inbuilt, already it is inbuilt that because it is a startup, because governance is not established, I would have already taken higher cost of capital. I mean with this, I'm thinking maybe in our documentation we can make it little more evidence, not only in the report but also in our documentation as to what is the basis on which I took the cost of capital, what is the basis on which I took alpha. Maybe we can be a little more conscious in documenting governance also.
So just to take off on what you said and actually see practically how we can Byju's the largest problem has been revenue recognition, right? Where they were recognizing revenues upfront for services that were going to get delivered later, or they were recognizing revenue for the hardware that actually was not sold and that was amortized, whatever it is. If the auditors had qualified it, let us say auditors also had not qualified at that time, right? In 2028. If the auditors had actually qualified it or raised a question mark on that, the valuer should have built it into the projections. Or he should have increased the discount rate, or he should have discounted that particular value. That is how I would build it. Coming out of risks that are existing, apparent, and actually that impact the free cash flows. And not governance issues that are outside of this and not quantified. If there is a fraud, if there is sexual harassment, if there is culture related issues where whistleblowers are not allowed to, how will we factor that in?
So, any other questions from the audience? Yes.
Employees of the subsidiary company are allotted shares of the holding company being outside India, and there are valuation reports being taken there for their regulatory purposes. Can that same be adopted here, or should it be the valuer should take those values that is being given there, or adopt a separate value altogether?
What is the purpose of the valuation? What are we doing?
ESOP allotment happening to the subsidiary companies.
So expense accounting in India, right?
And also for the income tax purposes, for perquisite valuation.
So
ESOP basically.
basically, from ESOP perspective, I believe we can. But again,
Let's say there is a 609 valuation there done in US.
For perquisite valuation, merchant banker question will come into the picture.
So what if the value is different from what is being denoted in US there?
No. Forget that. Practically speaking, merchant banker also cannot accept that value. Let's say, for example, HP as a company that has issued a huge number of options from the holding company to the Indian company subsidiary employees. Do we really assume that HP will share its valuation reports and so on and so forth with the merchant banker here to do a valuation of the purchasing? Answer is no. But HP being a listed company, the basis of value under 17.3 or whatever that rule 3 is different. It's a listed company. The data is available from a valuation. So you can take it.
For an unlisted company.
If it is an unlisted company, again, most of the times the way it gets structured is not as a direct exercise of a holding company's shares, but more as a cash settled instrument. In which case your valuation basis changes, even from perquisite perspective. You value it as a perquisite, which is a cash settled instrument, then value it. You can then value it based on that foreign company valuation.
Because the only question is whether if the government asks for a valuation report that where it is being given also. There is a 609 valuation there. And we are taking a 409 valuation.
It doesn't matter.
Yeah.
It's cash settled. This guy can only pay tax as far as what money he has received. He's an employee at the end. There is no accrual concept.
Any other questions from the audience before we take it to the last question, the panel? Okay, so the last but one. So I have two more questions. So in terms of like we were having a couple of discussions in terms of building the discount rate. So I'm taking it from there. So in terms of how do we know what is the discount rate we take when we factor in? So is it 50 to 60% discount rate to arrive at a reasonable value, or is it 25 to 35% discount rate to arrive at a reasonable value? So it all comes in the alpha or the company specific risk premium that we are going to add. So when we know that the projections are unreasonably high and it is very aggressive. So what is that value? So let's say previous round of valuation had happened at 500 crores, and now they have given a projections which we fit in the same kind of assumptions. It is coming at around, let's say, 5,000 crores. So 500 crore to 5,000 crore is a very big difference in terms of the achievability and all of that. Now, where do I mediate, or how is the judgment of a valuer has to place in terms of fixing the alpha in terms of the CSRP? So how do I get it? Whether it is between 500 and 5,000, how do I play that role?
yeah, my take on this would be that there are a few things which is very critical fundamentally when we think of alpha. One is what is the total expected return of the company in which we are looking. Let's say if it is very early stage, one of the key benchmark would be the VC return expectation, which will be about in the range of 25 to 30%. So if I am valuing a company which is in the very early stage where a VC would expect 25 to 30%, my discount rate also should be in that range. It's a broad line indicator. Other than that, another thing which comes to my mind is maintaining the consistency as a valuer. Whatever reports I am issuing, I should maintain a consistency as to when I am giving 5%, when I am giving 10%. We can even give up to 15%, 20% also alpha. So when I am providing this particular percentage, if I am maintaining consistency with rationality, that's a defense for me if somebody questions as to why you issued that, because it may go on like Girish was mentioning about GT cases, it may go on anywhere. So I need to ensure that I have the defense to support my inputs, whatever I consider. That is very important. Otherwise, I think the broader indicator will be depending upon the company stage. We can have a broader indicator of the cost of capital for different sectors of the industry. Different industry sectors and different growth sectors, and accordingly our cost of capital should align towards it.
But in that case, if we are following this kind of benchmark, then I get probably 4,000 crore or 4,500 crore. Is that justifiable then, or should the valuer look at rebuilding the model in terms of downsizing the projection? What is the turnaround?
Yes, rebuilding model is very much required if you are leading to unreasonable valuation. And many cases you can see that, for example, SaaS companies are leading to 45% EBITDA in year 5, 6, whenever it is turns profitable. That is very much unreasonable. Though promoters will always be optimistic, but we need to be, as I said, realistic at least, and say that okay, by the time you reach that 45%, 3-4 competitors will definitely come in, and you can't maintain that 45% margin. So that kind of rationalization of the prediction is very much essential.
So the solution here is to turn around or rework or revisit on the model as a whole, rather than increasing the discounting rate or alpha to 60% or 55 or whatever it is.
Yes. But a few things which you may come across practically, saying that the client will say that okay, this model is already submitted to the board. So again, you need to go by possibly what you are valuing, how you are valuing which company and all of that. But it is not good to take an unreasonable projections. But to an extent, if you are not too happy, if you can work around by slightly other things, I mean, little bit other inputs, modification, and because if at all somebody questions that, okay, how can 45% be achieved, then we have the ammunition with you saying that, okay, take some 10 pointers as to what possibly the possible arguments. At least it shows the preparedness, and ethically and morally you are right that, okay, you have done the justice for the work. But overall, it seems riskier to consider an unreasonable projection and adjust that with other inputs.
I just had one point right here. See, there in the US, the tax courts are very active in relation to valuation and scrutinizing the valuation reports. So there was this one tax circuit court in Pennsylvania, which called this concept of company-specific risk premium, small company premium, or this alpha as just as a fudge factor. It's something that is added just to derive a certain value evaluations. Now in India, what I'm looking at it is, I'm mainly looking at it from 56 to 10 perspective of income tax, where let us say income approach is adopted rather than the rule 11 value to determine the value, especially where non-residents are involved or when convertible instruments are involved in the transfer of these securities. There invariably you will have to go by income approach or any of your market approaches. If you go by income approach and you end up taking a company specific risk premium leading to a lower valuation, so that becomes a very hot spot for the income tax officer, and it is only a matter of time that they start looking at it. So building justification becomes important, and in my opinion, again not my firm's opinion, in my opinion, I think I also go with the tax court view that it is a fudge factor, but I also go with Chinmaya's view that the expectation of the VC funds is around 20-25%. Maybe the way in which we are computing CAPM models, where we are taking market return, we are going by mature markets while valuing early stage companies. Maybe that method we need to relook into. We need to start looking at different markets to arrive at market return and not your Nifty Sensex.
Also build upon a different model to arrive at the valuation. Yes. So moving to the end of the open house discussion or the panel discussion, the last question that I have to all the panelists is that how would you foresee for the next 5 years the valuation profession, and what are the things as a valuer needs to take care to be updated or being up to date in terms of the valuation profession? Anyone can start with it.
So in terms of being updated in the profession, I think the best way is to you yourself become an investor. So if you do a lot of early stage startup, try becoming an angel investor. Even small ticket sizes like 50,000 rupees to 1 lakh is still acceptable. So try becoming an angel investor and see how the things work. Or if not an angel investor, at least if you can start with a stock market investment and evaluate your investments. See whether your investments are undervalued or overvalued. I think that's how you can become true valuers.
Thank you for your input.
I think next 5 years, technology, database, and secularization of data is going to happen. So everybody will have the same information. Google will have it, AI models will have it, ChatGPT will have it, and so on and so forth. So application of your mind and actually using your discretion becomes all more important. So one way of doing it is by jumping into the pool and learning how it works. The other way is to actually continuously build your expertise and understanding of businesses, and therefore your ability to build risk premiums or ability to see a projection and actually understand whether it makes sense or it doesn't make sense, and so on and so forth. So these are all the generic answers on how you typically would keep in front of the valuation profession. But if you also see, this is one area from a business studies perspective that gets significant amount of interest thanks to people like Anjan who made it sexy, right? So there are tons and tons of research that comes. If you talk about a small company discount, like he said, Ashwat Damodaran, if you go by that man's hypothesis, he said that's complete fudge, because he said that there is no empirical evidence that a small company performs worse than a large company and therefore should have a higher risk rating. So like that, there are hundreds of research reports that come up empirically proving, disproving or supporting some of the assumptions that we've been taking. If you don't keep an eye on that, then I think you're losing out. Otherwise, everything else is typically how any other professional would actually continue.
Yeah, 5 years in Indian context, I think the regulatory framework, I think definitely could. I'm hoping that it will change. What Girish was catching up on in the morning, that is something I think it should change. Otherwise, like Girish was also saying, there is no point in the current kind of valuation reports which is being done where we are not too comfortable issuing for the costs what it comes to, and unfortunately that is how the market is. And I mean, you should be doing it at a large scale, then only you can really do valuations in India, in Indian market setup, and otherwise it doesn't make, it's only for your passion and pleasure you should be doing it. You will not really able to charge right amount of fees unless you're doing it in a large scale. But this regulatory clarity and all of that, I think once it comes, then it will be much more better, quality will increase, is what I feel. And also somebody touched upon industry, I think you were mentioning that industrial focus. I don't think industry focused practice would be a practicality in the next 5 years, but at least that direction is very important. And like Anjan was mentioning, you yourself go into the pool. There are a few LinkedIn posts also Anjan has made in valuing some listed companies and giving his hypothesis and seeing why that valuation is required. And such kind of analysis is very much required, and it is a very, very fascinating field. And anybody who is looking at this profession in the next 5 years, this is something, there is a huge amount of excitement and participation which can be possible in this field.
So thanks for the insights. I would take the pleasure for interacting with all the three of you. It was nice getting wisdom and thoughts differently, and in terms of your experiences and sharing your inputs was very insightful. And I would like to thank each of the panelists, Mr. Chinamaya, Mr. Girish and Mr. Anjan for participating in the open house discussion. And also I would like to thank the participants for asking questions and taking inputs from the panelists. So thank you all for participating here. Thanks for the open house discussion.
Thank you all the panelists and the moderator. May I call upon Vice Chairman Anjan to hand over a memento to our moderator, Mr. Kaushik. We'll have one group photos. Thank you all once again. Please spread the message about the startup sphere that's going to happen in the future.